Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I am your host, Dominic. Global geopolitical concerns and risks keeping investors on edge. So what are the safest and maybe correct moves right now? Joining me now is Matt Bartolini, head of SPDR's Americas Research at State Street Global Advisors. Also with us is John Davi, the CIO at Astoria Portfolio Advisors. Let's start with the bigger picture right now, especially in light of what's going on in the Middle East at this moment. What we have right now is a situation where, as of right now, the reports are President Trump is in the White House Situation Room speaking with his national security team. Also at this time, there are reports of what are characterized as missiles and or explosions over places like Qatar, Bahrain, and Kuwait. With all of that now placed in context, let's talk a little bit about international investing right now. Is the trend likely to continue in the second half of the year, Matt, that we've seen with outperformance in some of those international versus U.S. type investments, specifically in equities? Or has the geopolitical picture convoluted and upended that entire thesis of what happened in the first half of this year?
Yeah, I mean, I think when we look at the flow patterns, you start to see a divestment away from U.S. assets in the first part of the year based on some of the macroeconomic trends in terms of monetary policy, just less constraints by central banks overseas to ease and offer that liquidity impulse, but then also some extended valuations in the U.S. Then you mixture in some other geopolitical news and headlines around, the sort of one big beautiful bill and the sort of tax associated with that. And there was sort of a bias to go overseas. I think what we see now, the geopolitical conflicts in the Middle East, I'm not sure if that'll completely upend it. I think it might have an impact on sentiment, but we had started to see a broader divestment away from U.S., or just say lesser investment from U.S. There were still positive inflows, but we saw greater inflows into non-U.S. equities than their market share would indicate. And I think that trend will likely continue in the second half.
John, one of the big important points here is that, for the most part, many investors, whether they're retail or institutional, are allocating towards models or trying to target towards buckets specifically, and they alter the constitution of those buckets and the weighting of them to maybe adjust for the times. As an institutional investor yourself, I'm sure you have international or global type investments within your client allocations. Are you changing them at all, given what we're seeing right now in the Middle East?
Well, we would say that you shouldn't react to intraday news. You should have thoughtful portfolio construction to plan for periods of uncertainty. But at Astoria, we believe investing across asset classes. So we would have stocks, bonds, commodities. Commodities typically do well when you have geopolitical risk. Obviously you'll see oil go up. Gold go up, so that helps. And I do think that you have to have alternatives in your portfolio as well. So, 2025 so far year to date, has been all about the multi-asset portfolio, the all-weather portfolio. By our measure, that 60-40 portfolio that has allocations towards gold, commodities, real assets, international equities, and FX has outperformed the S&P 500 by 200 basis points year to date. So I think that, is comforting. Obviously, you have a lot more geopolitical risk, compared to a normal year. So, I would say don't overreact to intraday news, but, you should evolve your portfolio if you're just holding, SPYs, Qs, and T-bill, which is what the narrative typically was the last few years.
Okay, so with that in mind, you have then not, by your implication, you have not made any changes right now, given just what we've seen in the last couple of weeks. You're still comfortable with the way that you've allocated so far right now. And just for the kind of record for the viewers and listeners out there, what is your baseline allocation model? Everybody's different, but when you have a model portfolio, you kind of put a one-size-fits-all to the best you can and then adjust based on circumstances. What does it look like in terms of allocation right now?
So at Astoria, we are sort of neutral between like stocks and bonds. Between U.S. and non-U.S., we are very, very close to being neutral, like maybe 1% overweight the U.S. And part of that, Dom, is because we thought that international equities were very, very cheap. Obviously there's a lot of defense spending that's going on in Europe. They're just cheaper, right? So in big risk-off environments, which if that's a concern from investors, U.S. is trading at, Cape-Shiller P ratio 22.5. Very, very expensive, whereas international markets are a lot cheaper. So I would say, the real differentiator from our side is that, we are big believers in owning gold, commodities, energy equities. So the technical term is let's say gold and energy equities have positive skewness. So when you have an attack like today, what we're seeing live, those instruments will go up, whereas U.S. stocks will go down, right? So that's just helpful to have in a diversified portfolio.
Okay. With that in mind, Matt, let's talk a little bit about what the flows are showing. You alluded to some of those flows just a few moments ago. I wonder if you could tell us a little bit more about just what you're seeing in terms of where investors are and traders are going over the last couple of weeks. John just took us through a lot of the asset classes that he's dealing more actively with. There are also, of course, if there's an asset class out there that you can trade, there's an ETF that tracks it as well. So in the ETF landscape, are you starting to see more movement around some of these traditional geopolitical conflict-centric assets like gold, like crude oil? Maybe you could call cryptocurrencies these days loosely part of that portfolio as well. Defense stocks I can think of as part of that story. Those are the ones that are traditionally thought of. Is that what you're seeing right now? More activity there, or is this time slightly different?
Well, no, I think this year, and even so in the last couple of weeks, we've just seen this idea of investors building more resiliency into their portfolios. And I think many investors heading into 2025 actually had very unresilient portfolios. They're very concentrated in U.S. equities. It had been a trade that had worked for quite some time. U.S. equities that outperformed non-U.S. equities in 13 out of the last 15 calendar years. But investors were very concentrated in equities and very concentrated in U.S. equities. And we're very resilient to the wide range of outcomes that we're seeing in marketplaces right now, particularly as it relates to impacting growth and inflation dynamics. The growth and inflation dynamics this year are far different than the past 5 years, 10 years, 15 years for whatnot, particularly falling growth in the aspect or the notion of potentially rising inflation or inflation instability. And I think what we're seeing now with the conflicts in the Middle East, but also in Eastern Europe as well, is the sort of reaction function to the inflation channel. We see the spike in spot prices of oil, that it will have a transmission mechanism back into CPI, which could inflict higher inflation surprises. And that's why you do see some commentary from Federal Reserve officials, even over the last couple of weeks, of being more wait and see till you start to see those effects take place, in addition to even just the sort of potentially transitory nature of tariff inflation-led surprises. So what we have seen this year is inflows into gold, over 10 billion of inflows into gold. They react very differently, as John was pointing out, to surprises in the macro landscape, but also to the impacts of inflation and growth. Inflation-linked bonds are another way we've seen resiliency added, over 7 billion of inflows so far in 2025, another 500 million or so just in June alone. And in the same token, building resiliency is offering up some diversification. So as we were just talking about a few minutes ago, diversifying geographically, not being so concentrated in U.S. equities, but going overseas more so than you had over the last handful of years. But then again, going into something like energy, which does, as John was pointing out, has a different reaction to events in the Middle East, to events to the oil infrastructure than, say, tech stocks do. So that's where we see some of it. And then, of course, aerospace and defense spending is likely to increase, not just because of what's happening in the Middle East, but what we saw in the earmarks of the One Big Beautiful Bill of 13% increase. And so we see aerospace and defense ETFs, roughly 700 million of inflows over the last few weeks. Again, investors starting to position for different geopolitical risks, but also just the big trend is infusing some resiliency into a portfolio and being more diversified and preparing and not so much predicting for what happens next, because I think it's whatever happens next is really anybody's guess.
Sure, and that's one of those things that we have to deal with now is that you're going through multiple, situation or scenario type analyses, right? You're trying to handicap certain outcomes and what you think the reaction in the market will be. One of the things I want to talk a little bit more about, and we'll start with you, John, about this is During Matt's response, we showed you the intraday price action right now with missiles reportedly flying over the Middle East, explosions happening, U.S. military assets possibly being targeted directly. And yet intraday, as of this moment, we are seeing oil prices take a decent sized fall. They're down about 5%. We're also seeing gold prices rise only fractionally in this whole situation. I mean, you could say buy rumor, sell news, but it feels as though things are slightly, maybe not intuitive. What's happening with the market right now is just not intuitive. And John, I wonder what it says to you as a chief investment officer when you see seemingly escalating military conflict in the Middle East with a reaction function for commodities and gold that doesn't exactly click with those developments.
Yeah, we would probably, want to see, a few more data points, a few more days, if not a week longer, just to see, okay, what is if this is some major cataclysmic risk-off event where the S&P goes down, 15, 20%, oil and gold will de-risk lower just because it's a broad-based, kind of risk, bringing exposures down, right? Nets and gross down. But, I think the market just needs to kind of get more, see more data points to see, if you're really going to kind of, de-risk a lot further than it is now. So I'm sort of not surprised. We sort of rallied overnight, rallied at the open. Now there's, more news speculation, so a little bit risk off, but it's too early to tell, I think.
All right. As we talk a little bit more, Matt, about this ongoing issue with the markets and how they're pricing things, is there a way that we can look perhaps for investors to hedge traditional portfolios? What exactly are you seeing in terms of maybe some contrarian ideas that are coming into favor with regard to some of this particular type of move? We've talked oil and gold, and maybe I've even alluded to crypto and Bitcoin, but how exactly are you seeing possibly either investment advisors or retail investors maybe look to kind of position themselves given what we are seeing in the news right now?
So I think there's been a handful of trades or allocations that would sort of intuit where advisors are starting to position for this market to sort of mitigate some of the geopolitical-led volatility. I mentioned it earlier: gold, inflation-linked bonds, even short-term T-bill ETFs. Going into cash in case risk premiums widen, you'd be sort of insulated from that perspective. But one of the areas I think we've seen allocations, it sort of exists outside of the geopolitical sphere, and it's actually more fundamentally driven. So we've seen sizable inflows in the communication services ETFs, roughly about $1 billion or so. And we think about, what are some of the other mega trends or headlines going on about there? And it's AI, it's enhanced connectivity, cloud computing, and that's really where communication services firms really live, right? They're able to, have that exposure to Magnificent Seven, high cash flow equities, low debt to equity. You're not really going to be impacted by the Fed keeping rates elevated for quite some time. They're more service-based. They're not going to be embroiled in a lot of the tariff-related volatility. So I think that's one area, is look outside of the sort of cause and effect relationships we're seeing from a geopolitical and macro perspective, and where there are fundamental tailwinds to help sort of insulate from the macro. I think communication services is one of those, and we look at it on a cross-asset momentum trend basis. It ranks one across all other sectors when looking at our momentum ranking too, and I think that speaks to some of this fundamental durability.
All right, and of course now there are ETFs where you can track some of those specific factors that you're referring to as well right now. John, I'll end with you and maybe some of your best ideas given what we are seeing right now. Is there anything that you think, given the recent price action, might be an opportunity or a place you want to go to in terms of a possible relative safe trade?
Yeah, so I'll give you two ideas. One is an ETF we manage, PPI. The second one is from Bank of New York Mellon, BKGI, which is an infrastructure ETF. So, 3.5 years ago, we, M2 money supply exploded. We increased our balance sheet. We flooded, the market with dollars. And, in my economics 101 class, they taught me that if you restrict supply, you increase demand, prices go up, inflation goes up. So we launched PPI, and in the last 3.5 years, we've beaten the S&P 500, and no one thought that inflation would be, higher, sticky for longer. So We've beat the S&P 500 by about 500 basis points. Year to date, it's up 11%, as you see on the screen. S&P is up 2%, so nice, relatively, healthy outperformance. And gold is actually like 9% of this fund, so it's a very high conviction view that we have. The second one is BKGI, which is on the screen. Infrastructure stocks. It plays into also this elevated levels of inflation. It's a global basket. It's up 27% year to date. You don't find too many things that are up that much in the marketplace. So it kind of tells me that there is a trend. It is clearly an elevated level of inflation. And just these are cheap stocks at the end of the day. The PE ratio of BKGI is 13. So our fund PPI is about 16. So S&P 22.5. So the idea is that you want to mix some of these idiosyncratic bets in the portfolio. They are value stocks. Value investing can work, even though that gets a lot of scrutiny. But both the plays on just kind of real assets, elevated levels of inflation.
All right, a fascinating conversation. We could go on for hours about this, but thank you very much to John Davi and to Matt Bartolini. Remember, you can catch that and all of our ETF Edge installments. Just head over to etfedge.cnbc.com. Thanks for joining us here on ETF Edge. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.